Hey, happy Monday, everybody. Hope you had a great weekend. This is Ray Cruz. I'm here with Amir Karami with MCF Mortgage, and today is Monday, and that means it's our Intelligently Deal Desk, our MID. And today we're actually going to just piggyback off of Friday's episode of our MIU, which we talked about mortgage insurance and do you really need 20% down, and how, what options available to you guys are to your clients to not put 20% down, and why they don't necessarily need to do it, and probably why they shouldn't do it sometimes. And today we're going to talk about a specific situation and transaction that Amir had with his clients where they ended up actually putting less than 20% down, because for this particular transaction, they actually didn't even qualify, for a loan that they were doing. So Amir was able to work up his magic, and, being the expert that he is, and the great listener that he was able to come up with an amazing plan to get these folks to closing. So a great win for Amir and for us and for the clients, obviously. So Amir, go ahead and share.
Hey, all right, a lot of compliments there. I don't know if they're all deserved, but appreciate it.
Absolutely.
Guys, so yeah, I mean, on Friday when you tuned in to Ray and I, Ray described scenarios where you could get around having 20% down. Prices have gone up substantially everywhere. I don't care where you are, prices have gone up. I don't know a market that prices have come down in. We had the opportunity to help this family last year in Silicon Valley. They were a young family with a newborn, and they were trying to get out of an apartment and move into a small single family home. Just give you some context, a small single family home in Silicon Valley is about 950 square feet, and it costs about $1.2 million, wow. Right? And this isn't like the Beverly Hills of Silicon Valley. It's your average middle of the road neighborhood with a great public school system, but nothing extravagant, a home that they probably had to get into and spend some money in. Now, 20% was, they did not have it. They had 10%. So Ray gave us one strategy to get around that. And one strategy that he talked about was mortgage insurance. But the other one that applied in these circumstances was a first mortgage and a small HELOC, okay? So in this circumstances, we try to do a jumbo loan. As Ray said, we do jumbo loans. We do jumbo loans. Jumbo loans are any loan that's over the high balance conforming limit for that county. So every county is different. If you guys have any questions, give Ray or myself a call. Send us an email. Our email is teamcg@MCF Mortgage. And we'll be happy to give you what your max, the high balance limit is for the county. Some have it, some don't. But anyhow, they did not have 20%. They had to go jumbo, and we did do jumbo with 5 and 10%. Now, what was the problem with them was we couldn't qualify them for jumbo. Jumbo, this is right in the middle of COVID, where lending guidelines got tight. They got very tight because no one knew what was going to happen. No one knew that it was going to be such a big real estate boom. No one knew that Zoom, like this meeting and things of that nature, the virtual world, were going to let things function as they were for certain industries. So lending guidelines tighten up, and specifically debt to income ratios. And we'll do a video, guys, on debt to income ratios. So some of the stuff I may say right now may be too much, information and not enough context, but we'll discuss debt to income on another video coming up. But anyhow, every type of loan has a debt to income ratio cap. And at this time, going back a year, it was 43% for jumbo loans. Our borrowers could not qualify because their debt to income ratios were higher. So what we were able to do was we were able to structure a first mortgage and a second mortgage, still with the 10% down. So what it's called in our business an 80-10-10. Give them a mortgage for 80% and then of the purchase price, then one at 10%, a HELOC, and then their own 10%. We were able to squeeze them in right before they would cap out at the DTI level for a first and second, okay? They bought the house, moved in happily. And as part of what we tell you guys, financial literacy, and what we talk about in every video, we try to come back every year, if you allow us, and I think it behooves everyone to allow us, is to revisit your loan and discuss it and see if there's any way that we could save you and your family more money and increase your wealth. Sometimes there isn't, but sometimes there is. In this particular circumstance, when I reached out to them about a week and a half ago, 2 weeks ago, we had just got news that the Fed was, inflation numbers were high. We've done a video on inflation and how that affects the interest rate market, and that the Fed was going to move rates up at some point in the near future. Now, HELOCs are traditionally adjustable rate mortgages. So during our annual meeting, we call it a MUM analysis. MUM analysis, guys, MUM stands for mortgage under management. We went through scenarios. We forecasted good scenarios and bad scenarios for the second mortgage. And they decided, and with our help, with our financing, with our financial forecast, that it might make sense now to just combine it all into one loan. The county loan limits have gone up substantially countrywide, and they've gone up. They're going up as of January. We've been doing these loans since November, however. Now they've also their equity has gone up. So this is a house that they bought with 10% down. The house has gone up by almost 17% on top of the 10, right? So now they're back. They're even getting a better rate on a first jumbo mortgage than they had on their conventional with a second mortgage, because they have so much built-in equity. So in these circumstances, again, they were able to secure a house that's gone up 17 odd percent. So imagine, guys, on $1 million house, that's $170,000 gain in equity, in net worth for yourself and for your future. They've got that equity. And now we're coming back, getting rid of a second mortgage for them that they were a little bit concerned about because of the Fed's policy towards increasing rates. I mean, it's a win-win, and they did it with 10%. They didn't wait. They took our advice. They came through our pre-approval process. We went through all their options with them. We designed financial plans for them, and we came back and analyzed it a year later. And we do this with every single borrower. We do a financial analysis every year. Ray and I always like to say, our job doesn't start when you close the loan. I'm sorry, it doesn't start until you actually close the loan. I said that wrong. I'm sorry. Our job actually starts when you close the loan, because we're not in it for just closing the transaction and disappearing. We're in this to make sure that you, for the next 30 years or for the next 20 years, whatever your family and life goals are, that we're providing you the correct financial analysis to achieve that. There you go, Ray.
Thanks for sharing that. What a great, I mean, that's so inspirational, actually. And it's a great win for this family, to be able to get out from the home equity line of credit, I believe that you had mentioned that they had there. So, a couple terms that Amir used during that example there he gave us was, he referred to a HELOC. So for those of you guys that are out there that may not know, so a HELOC is an acronym for home equity line of credit. You guys might have heard of a HELoan as well. And a HELoan is a little bit different from a HELOC. And maybe I'll ask Amir if he can, just talk to us a little bit about the differences between a HELOC and a HELoan.
I'm gonna punt that back to you. You're the HELOC king. I'm just a student. I'm gonna let it go back to the master.
So with that's a good one, Amir. Yeah. So with that, with a HELoan, there's just basically minor differences between the two. So with a home equity line of credit, you have an interest-only payment. So in this case, it's probably why the borrower had offered, or what you guys did with the borrower, Amir, was an interest-only payment on the home equity line of credit.
Yeah, if you don't mind, I'm gonna put my video on a quick pause. I have someone that just knocked on the door about a loan that's closing. Give me one quick minute. Hold on 1 minute, guys. Sorry about that.
All right, so you guys, we have a home equity line of credit, which is an interest-only loan. And then the other part that makes it different than a home equity loan is the fact that it is a variable rate. And Amir actually mentioned that in his transaction that, these clients had an adjustable rate mortgage, and they had the adjustable rate because, hey, welcome back. Because of the home equity line of credit. So when he was doing his analysis with them, right, I'm sure he went over the fact that, hey, look, rates are going up. The home equity lines of credits and home HE loans are typically tied to the Wall Street prime rate. And as that prime rate increases, so will your interest rate on that home equity line of credit. Where the home equity loan has a fixed interest rate, right? And it's a principal and interest payment. So why do people more than likely take the home equity line of credit initially instead of the HE loan? It's because of the interest only payment, right? That interest only payment gives them overall lower monthly payment at the end of the day, because there's no principal. They can pay it off anytime they want. And once they pay it off, they can actually just keep it open. They don't even have to close it out, right?
Right.
Is that right, Amir?
That's correct, right?
Yeah. So, and a lot of times, they can keep it open and leave it there for rainy day funds. Unfortunately for Amir's clients, obviously didn't have the funds to pay the home equity line of credit off. So the best solution for them was because they also had the equity in the property, was to do a refinance, combine both into one mortgage, like Amir said, into a low fixed interest rate. And that really worked best for them. So hopefully you guys got a lot out of this. We do get scenarios like this very often, where you would go, we do the analysis, go back to this analysis that Amir is talking about, which is, if you don't have the 20% down, are you better off with a home equity line of credit? Are you better off with a home equity loan? Are you better off paying mortgage insurance, right? On your transaction. So you guys out there, you have any clients, that are sort of sitting on the sidelines and don't, because they don't have the 20% down, please, have them contact Amir, have them contact myself, where we can, just educate your clients on all of the different options available to them, especially in today's environment with increasing interest rates. We talked about it on Friday, the cost of waiting. It's going to end up hurting them in the long run. You want to say something on that, Amir?
Yeah, I mean, all your points are extremely valid, right? I mean, cost of waiting for sure. I mean, we see gas prices go up every day, right? It's due to inflation. Home prices will go up because of inflation as well too. Everything goes up, and when rates are going up, so when you wait, you're losing out on the equity gain. You're losing out, and we keep hammering this. And I think we did a video 2 weeks back. The deal, the bargain, everything right now is the interest rate. It may not be the home price. It's the interest rate. Getting in, getting fixed at a low rate for the next 30 years. You're borrowing less than what inflation is. It's the first time it's happened in 41 years where interest rates are less than inflation rates. So this is the deal, guys. This is the opportunity in the housing market. That's my point on that. Number two, make sure that your loan officer's job starts the day after you close, not prior to when you close. Yes, look, we all have to get you to the closing table, right? That's a given. That's what we get paid to do. That's what our job is. That's what we signed up for. A lot of us haven't signed up to be your advisor for life. Some have. I count myself and I count you as the type that we've signed up. We truly do believe that our job and our function is really meant to begin after you close. Because Ray, you brought this up. Everyone thinks that they have a house. It's an asset. And yes, it is. It goes up in value. Sometimes it goes down, but generally it goes up. If you look at a 100-year period or a 40-year period, home prices do go up. But that asset has a debt associated with it, right? That debt, every month you're paying it down. Our goal, however, is to manage that debt. So instead of you having to pay it down in 30 years, can we find a technique? Can we find a loophole? Can we do something to pay it down in 25 years, to give you that freedom in 20 years? Right, guys? That's what mortgage planning is about. And we hammer this home. Wow. Sorry, guys. I'm excited. This topic got me excited. We find ways to get you to where you need to be. Okay. What a blooper that is. America's Funniest Home Videos. But guys, there are ways to reduce mortgage payments. There are ways to reduce interest and principal, and make sure that if your lender offers it, do that analysis. We offer to every single client. You get calls, you get emails. It's a free advisory service, right? When you go to your financial planner, most financial planners charge you a set fee to give you a financial plan every year. As loan officers, we don't charge you a thing to manage your debt. And I promise you, Ray, that with 95% of borrowers, their debt is more than their assets.
Absolutely.
So guys, take advantage of it. You know, we have a lot of tools available to you to allow you to succeed and allow your family to succeed. And Ray and I, you know, and I'm not kidding. I learned everything I did from Ray. He's been in this business for a very long time. You know,
I just don't look it.
Yeah, right. Always learning. We're always learning too. But guys, take advantage of services. And we're not the only ones. There's a lot of great loan officers out there. This is not meant to promote us, although we love to work with you guys. There's a lot of qualified lenders out there. But work with someone that this is the tenet of what they do, financial literacy and looking out for your wealth and looking out for your future, rather than, hey, you know, sometimes I get calls, hey, what's your rate? I mean, we talk about this, but I've also had calls say, hey, I went with this guy, he gave me this rate. And then when you do the financial analysis and you compare them, yeah, they may have got the best rate back then, but they didn't get the right mortgage plan. And that rate is costing them thousands, to the tune of, you know, 30, 40,000 because of the product that they were put into. Just because they said, I want the lowest rate, the loan officer's like, all right, here's your lowest rate, go on with your life. No consulting them, no advising them, no planning for them. So guys, take advantage of guys like us and gals like us that exist. And that's it.
All right.
A lot of bloopers today on my end. I'm sorry.
It's all good, Amir. All good. It's all
right
good.
Before Thanksgiving, we're trying to get, we're busy, guys. We're trying to get short week. We're trying to get people closed. So I'm sorry for the interruptions into the office.
Yeah, no, it's all good, Amir. And look, and this is our you know, mortgage intelligently deal desk. We want to talk to you guys about specific scenarios that come into you know, our laps and that we work on a regular basis, right? So this was, you know, a mere scenario that he talked about. And, you know, although the initial client was from a year ago, that refinance was recently, right, Amir?
Right.
Yeah.
Pending right now.
It's pending right now. Yeah. So thank you guys for tuning in. Hope everyone has a great Thanksgiving and gets to eat and enjoy themselves with their family. And we'll see you guys back here on Monday, next month, a week from today, I think.
Right. That's
right. The 29th, I believe. So.
Right. All right, guys. Happy Thanksgiving. Gobble up.